All right, let's talk about a term that trips a lot of people up: tax phase out. You hear it and, I don't know, it just sounds kind of scary, right? Like you're walking along and suddenly, bam, you fall off a financial cliff. But what if I told you it's not like that at all? It's way more like a gentle slope. So let's break down what that really means, and you'll see it's actually pretty straightforward.
Okay, so what is a tax phase-out really? Well, at its heart, it's just a rule that slowly, and I mean slowly, dials down a tax deduction or a credit the more money you make. That word gradually is the key to the whole thing. Let's dig into what that actually feels like in the real world.
So first things first, let's get one big misconception out of the way. A phase-out is not a cliff. It's not this scary all-or-nothing trap where, you earn $1 extra and poof, your entire tax break just vanishes into thin air. That would be terrifying, but that's not how this works. Instead, think of it exactly like this. It's a gentle slope you just kind of walk down. It's predictable, it's gradual. As your income ticks up, your benefit just eases down little by little. There are no sudden drops and definitely no nasty surprises. And this right here really paints the picture, doesn't it? On the left, you've got the cliff. That's a super high-stakes situation. Earning just $1 more could literally cost you thousands in an instant. No thanks. But on the right, you have the slope. That's our phase-out. It's built to be manageable. Earning more only costs you a tiny proportional piece of that benefit. It's a way, way more predictable system.
Okay, so how does this slope actually work? Like, how do you calculate it? Well, you're going to love this. For a lot of these phase-outs, the entire thing boils down to just two numbers. That's it. Once you know those two numbers for whatever deduction you're looking at, the math is actually surprisingly simple. All right, number one, this is your starting line. It's the income threshold. For the example we're going to walk through, that gentle slope officially kicks in once a single person's income goes past $150,000. Now keep in mind, this number can be different for other deductions or if you're married. But the basic idea, the logic, it's always the same. And here's number two. This one tells you how steep that slope is. In our case, it's a 10% reduction rule. So what does that mean? It tells us exactly how much of our deduction we lose for every dollar we earn over that $150,000 starting line. So let's put those two things together. Here's our rule of thumb for today. Your tax deduction gets smaller by 10% of the amount your income goes over the $150,000 mark. Simple, right? Okay, theory is great, but let's see how these numbers actually work in the real world. To make this all feel a bit more real, let's meet Jordan. We're going to follow Jordan through a few different financial situations to see exactly how this whole phase-out thing plays out in practice. So here's the quick rundown on Jordan. Jordan's a manager at a high-end restaurant and files taxes as a single person. And just for our example, let's say Jordan is eligible for this really nice, hypothetical $25,000 tip deduction. Now, we're going to look at three possible outcomes for Jordan's year. We'll see what happens if Jordan's income is under that limit, what happens when it lands right in the phase-out zone, and you guessed it, what happens when it goes way over.
Okay, scenario number one. Let's say Jordan has a good, solid year, brings in $140,000. Nice.
So remember our starting line, $150,000? Well, Jordan is under that, so the phase-out rule doesn't even wake up. It's not triggered at all. Jordan gets the full maximum $25,000 deduction. Easy peasy.
All right, let's switch it up. Scenario two. This time, Jordan has a great year. Makes $180,000. Now, this income puts Jordan right on that gentle slope we've been talking about. Time to do a little math.
And don't worry, the math is just a simple three-step process. First, we figure out how much extra income Jordan has over the limit. Second, we use that 10% rule to see how much the deduction shrinks. And third, we just do a little subtraction to find the final deduction amount. Let's do it. Step 1. We need to find out how far over the starting line Jordan went. So we take the $180,000 income and subtract that $150,000 threshold. That leaves us with $30,000. We'll call that the excess income. Okay, on to step 2. We take our 10% rule and apply it to that $30,000 of excess income. So 10% of 30 grand is $3,000. Now this is super important. That $3,000 is the amount of the deduction that Jordan loses. And that brings us to the finish line. Step 3. We just take the original maximum deduction, that was $25,000, and we subtract the $3,000 reduction we just figured out. And there you have it. Jordan's final, actual deduction is $22,000. See, not so scary, just simple math. All right, one more, scenario 3. What if Jordan has an absolutely phenomenal year, just crushes it, and earns $400,000? Okay, at this point, Jordan is way, way down that slope we've been talking about. But guess what? The math works the exact same way. The excess income over $150K is $250,000. 10% of that is $25,000. So the reduction amount is $25,000, which is the entire maximum deduction. That means the benefit is completely phased out. Jordan's final deduction here is a big fat zero.
So when you put all three scenarios side by side like this, you can really see the whole journey play out. When Jordan's under the limit, boom, full benefit. When Jordan's inside the range, it gets a little smaller. And when Jordan's way over, it vanishes completely. It's that perfect, predictable slope, taking the deduction from $25,000 all the way down to zero.
Okay, so we've done the math, we've walked through the mechanics, but let's zoom out for a second. What's the big picture takeaway here? What does this actually mean for you?
If you remember one thing today, make it this. It's a gradual slope, not a sudden cliff. Seriously, the more you make over that limit, the smaller your deduction gets until, yeah, it eventually disappears. Once you really get that, you can actually plan for this stuff as your income changes. No more fear of those sudden, nasty tax surprises.
And here's the best part. This isn't just a one-off trick. The same logic applies all over the place. That simple three-step process we used, you can use it for all sorts of other phase-outs. Yeah, the numbers might change, the income level or the percentage, but the method is exactly the same. For example, there's a $12,500 overtime deduction that uses the exact same income threshold and 10% rule. The point is, you now have the toolkit to figure these things out on your own.
So, I'll leave you with a thought. Now that you see how a phase-out is really just a simple step-by-step calculation, what other tax rule out there that used to seem super complicated now feels, well, a little more manageable?